This segment, we're doing top 10 questions that our investors have asked us over the 15 years we've been doing this. So first question, is my investment backed by real estate? How am I protected as an investor? So when we buy a mobile home park, we put together an LLC for each ownership of each piece of real property. So that LLC wholly owns the mobile home park, and that specific LLC owns that mobile home park. So when we raise capital into that LLC, you're owning your direct pro rata share of that LLC that owns the real estate. So even if you were to ask me, hey, I have this rental home over here, it's worth $1 million, what would you suggest as a legal structure? I would say you should own that house in an LLC. And it's not that expensive. You got to pay the $800 a year to the state of California if you're in California. But it's so much better for liability risk protection. Also, it gives you a ton of optionality on the 1031 exchange side. You can use it to exchange into groups like ours, whereas if you just hold it in your trust, then it limits your options and you have to structurally work around that a lot. So yes, you are a direct owner of real estate. We just own it as an LLC to reduce liability risk. Second is, what are the tax benefits of investing in manufactured housing communities with Comfort Capital? Just to be clear, when you invest in a mobile home park or manufactured home community with us, you're investing in that community. You're not investing in Comfort Capital is just our brand for going out there and having conversations and raising capital. When you invest, you're investing in that particular fresh entity, like I just covered, that owns that mobile home park exclusively. So you're investing directly into that LLC, nothing to do with Comfort Capital. And the benefits are, it's multifamily equivalent in cash flow returns. I'd say I'm broad stroke here, but low to upper teens is what we're seeing. Our average leans towards 20% annual return. Our deals today are higher level, higher quality, more expensive, better locations, better utility situations. So they're a little less on our pro forma than 20%, but they're in the 12 to 18%. And with that return level, and that includes cash on cash is roughly 5 to 6%. And then we start edging, and it edges up a quarter to half a point a year typically. And then the depreciation, which I think is huge. So we just covered like cash on cash and appreciation. Depreciation of the infrastructure on mobile home parks is second to none, other than like oil drilling and things where you're super heavy in equipment. So with mobile home parks being a more or less a multifamily cash flow asset, you get to play the tax game just like every other piece of real estate and or improved real estate, but we're mostly land and infrastructure. So that's water pipes, sewer pipes, electrical infrastructure, a clubhouse, a pool. And we don't own typically very many of the homes. And let's just sidebar, manufactured homes. They're personal property and they're basically a car from a tax standpoint. So you can write them off in 5 years. So even if you end up with a pool, 10, 20, 30 homes out of 100 or 200 units, manufactured home spaces, all of the purchase price is split up into these buckets. 80% on average, it swings a couple percent, 80% of the purchase price. So let's just say a $10 million mobile home park you buy, 80% or $8 million is allocated towards improvements and is under 15-year depreciable assets because it's all infrastructure. You set aside 20% for land and as the real estate. And so you can't depreciate the real estate. So you get to front load and have huge tax benefits, especially if you have other real estate holdings and it offsets your gain or your cash flow from those other real estate holdings. And so the depreciation is a hidden gem in the space. Everyone uses it if they can, but there's a lot of institutional pension fund equity that's in the space that honestly, it's frankly wasted on them because they don't have the fund structure to utilize the depreciation. So we love the depreciation for that. And so if you're able to use it, our clients typically are, and that's one of the reasons why they like our asset class so much, is that it's not only a great return, a great asset to own, cash flow, the upside and the growth is all there. That doesn't change. But you get a huge, almost even today with the tax situation where it is, 40% bonus, and it steps down, you're still 40, 50, 60% in the first year. Now, once it goes away, it might get renewed, but if it doesn't, it's still like half of the 80 or 3/4, so whatever, 60%, even standard deduction, standard 15-year straight line depreciation schedule, you're still getting 20, 30% in the first couple of years. So it just helps offset other income and other passive income from other real estate holdings so much greater than a standard real estate asset. All right, how do you find your deals? Okay, so our acquisition criteria and how we find our deals is major metropolitan locations, typically trying to get above 2-3 million people. The more people, the merrier. Then the markets that we specifically focus in on are the markets like Phoenix and Dallas. We don't really have the same supply issue that multifamily and storage has, where there's new supply. Mobile home parks demand in those growing markets, especially for workforce, has been maintaining and very strong. So we look for those markets, those irreplaceable locations in growing metropolitan location in the city, and 100 sites, mobile home spaces or more is our sweet spot now, which is roughly 10 acres plus of mobile homes. We buy existing. We love city water, city sewer, and direct build electric is the baseline deal qualifiers. What makes MHCs a better investment than apartments or other real estate? So the biggest thing to know about manufactured home communities is they are really tough to build. And whether that's getting them approved by cities because it's not a great use of land, it's not as dense as apartments, it's just really challenging to bring new supply online. Then mix that with the mortgage challenges with manufactured homes on their own, or an older mobile home, even worse from a credit risk standpoint for the lender. It's not car loans. Like, they even have better car loans for used old car loans than they do for mobile homes. So it's a challenging asset to grow supply. And then we're probably half or 60% of the cost with space rent and home factored in than a multifamily apartment of equivalent quality in the similar market or submarket that mobile home park is located in. So it's much more stable. We have far less turnover. So apartments have anywhere from 30 to 50% turnover I'd say on an average. So a 100 unit multifamily asset, 30 to 50 people leave, or leases turn over, and they leave and new ones come in. We have max 5% turnover in mobile home parks because, again, we focus on having the tenants own their home. So I'd say that the supply constraint is the biggest, and then the affordability factor of our homes in a given market is the biggest. What are the biggest risks, and how do you protect investors against them? I think that the biggest risk today is regulatory. So from when I say that, a rent control, and that's why we're focused on a market like Phoenix and Dallas and those states where they have some format to fight against rent control. And then probably liability and insurance cost. That's probably 1 and 2, because everyone in the economy gets a little bit squeezed, or the economy ebbs and flows, but the tighter it goes from, I'd say it's 20 25 and the economy seems to be slowing a bit, the more friction you put on the lower income levels, the more litigious likely you are to get sued. So and then you have natural disasters, which I'd say is probably the third risk, but that goes back to insurance and the insurance cost. That's probably our biggest battle from cost control is insurance. So I'd say that's probably it. But we've figured out ways to buy master policies, bigger policies that blanket all of the deals separately, but we can buy it in bulk. And so it deals with that risk. And we're buying better insurance for every piece of the business. We have great advisors on the insurance side, and we continue to hedge everywhere we can and reduce risk. Where do manufactured housing communities fall on risk return spectrum? Are these core, value add, or opportunistic deals? We've slowly moved more towards core or core plus in quality, because as we have a 15-year track record, the best performing returns, IRRs, average annual returns, have been the highest quality, best located deals. So you go in tighter, cap rate, cash flow, a little bit more snug, to where it feels on the first couple years like you're not getting a great return. But when you put that 5, 6, 8 years, your rent growth is better because the location is there, your occupancy and the consistency of your expense load, everything, your net operating income grows exponentially on the year 5 to 10. And then cap rates hold tighter on those deals, and they are the most sought after from an asset standpoint from a group that's looking to buy manufactured home communities. These mobile home parks in metropolitan locations that of that higher quality are becoming like unobtainium, like you can't replace them. And so the irreplaceable nature really, really helps the core plus deals, which is okay. How do mobile home communities compare in affordability to site-built homes or apartments? I'd say with interest rates at 3, we were looking, man, you can go buy a house for under $2,000 a month in some of these submarkets that we were in. Now it's not even close, $3,000+ a month for a home down the street, when you can live in our mobile home park all in for probably under $1,200, $1,300 in Phoenix. Dallas, same thing. Space rents are climbing, but over 5 to 10 years, they'll be, $1,300 to $1,500 in these major metros. So we're half, if not a third of the cost of site-built homes. So that today with interest rates at 6, 8%, that's a no-brainer. Is Comfort Capital vertically integrated? And who actually manages the properties day to day? Comfort Capital is the asset manager. We sit and oversee the mortgages, like when to refinance, when to sell. The total scope of the investment is the focus of Comfort Capital, putting new deals together, deciding when to sell. That's Comfort Capital. Comfort Communities is our original company that we started in 2009, and it does all the property management and employs the entire team in the field. So we have roughly 40 property management type people, and that goes from regional managers down to area supervisors, quality control people, which run around. Now it's really slick with iPhones. You can take pictures of violations and send text blasts, and you name it. There's really cool tools now to manage. So our Comfort Communities team manages the day in and day out operations for all of the mobile home parks in the portfolio. How are your deals structured? Are these funds, single asset syndications, or something else? So the fund structure is something to be visited down the road, I think. But we really like currently single asset syndications using LLCs. We're looking into series LLCs, which allow you to basically raise money into one master LLC, but then own, let's say, 5 or 10 mobile home parks underneath that. And you can play with the people that really love Phoenix, really love Dallas, you can play with that, but still get all of the tax benefits of how we are currently using single asset syndications. So I already said it, but when we raise equity, we put them into fresh, brand new single ownership, single property LLCs, and then you buy your pro rata share in that deal. That's the current structure. Then we do tenant in common if you have larger exchanges, and you'll own that portion for 2 to 3 tax return years. And then we'll blend it into a fresh entity across the board and make it really clean for the long-term 1031 prospects for that entity and that partnership. What's your long-term strategy with these communities? Are you flipping, holding, or refinancing? We want to become the long-term community owner and operator that focuses on the highest quality, best located, and best infrastructure layout, in general, the highest quality manufactured home communities in a given market. Because we see a trend of a large amount of institutional capital trying to penetrate into the space and deploy hundreds, if not billions of dollars into manufactured housing. And so it's really become almost like a gold mining effort. We're all mining for these historically owned, long-term mom and pop owned and operated mobile home parks that maybe have been bought a couple of times since the mom and pop, but all of us are trying to build scale, because the more scale you build, the more consolidated your management team is, the more efficient your operations are, your net operating incomes across the whole portfolio get better and better. And then you cannot build these any longer. And being that they were all built in the 60s, 70s, and 80s, from I'd say a statistical standpoint, they were all built in the 60s, 70s, and 80s. The supply of these mobile home parks, you can't build them, and they were built in locations that you can no longer even make sense of. They are in urban environments, which make them really competitive and stay highly occupied, 95% occupancy plus on average. And so they're just a really great long-term hold asset. And so over the next 20 years, we'll be pruning some of the smaller assets, maybe putting a few of them together so that they benefit from some of the scale, like a bunch of 50 units you sell to get to a couple hundred units, so that the larger institutionally backed operators come in and they can spend enough money to make it interesting. And you get that price per unit premium and the cap rate premium for that scale. And we'll start pruning those smaller assets that I'd say long-term, we just would rather own higher quality, and start grooming a really great long-term cash flow heavy manufactured home community portfolio.
All right. If you're enjoying this content, hit the subscribe button and turn on notifications, and check out the description below for our websites listed. Thanks a lot for joining.